What's the possibility of a financial failure of California government, and if there is a failure, what happens? And by failure, I'm assuming what we're talking about is bankruptcy.
Okay, yeah, well, first let me address that whole free lunch thing. I got a free lunch today plus an ice cream bar. So, now I'm going to go back to California so you can get ice cream bars too. Make it work. Well, the controller warned earlier this year that we were going to have a cash flow situation where he's just going to run out of cash to pay bills and have to maybe start issuing IOUs. And that spurred the legislature to make some changes that could be characterized as cuts to solve the immediate problem. And a couple years ago when we had the IOU situation, the way they got out of it, because the state can't declare bankruptcy, they just issued IOUs to cover bills while they could. And so vendors, who were doing printing and whatever for the state, building freeways and things, were just going unpaid for months and months and months while the legislature argued over various things and delayed the budget. And it was a huge crisis. There are occasional efforts to make it so certain bills would be paid even when that happens, but then, those often die because people think, well, then that takes off the political pressure to solve the problem. So it's a mixed bag. You want
It was
people
such a huge crisis that your legislators didn't get paid, and so I understand.
Well, now, thanks to Prop 25 passing, which, had a lot of bad things in it, but the one good thing and the only thing that was really mentioned in the campaign was that if the lawmakers don't pass a budget on time, they forfeit their salary, and they forfeit it completely. They don't get it retroactively when the budget passes. So for any time that it's not passed, their salary is gone.
I wouldn't have a lot of impact here. I mean, it's a great threat to hold over their heads, but I don't see any of them quaking in their boots here.
We questioned that in California as well, because, like I said, that was the selling point for this initiative that otherwise did a lot of things that a lot of people were opposed to. That was the only thing they mentioned. This punishes lawmakers.
And how much is their salary?
It's 95-ish, I think now. It was cut.
It's like 130 something.
Yeah, it was reduced by an independent commission a few years in a row, but then they get tax-free per diem.
All right, you can all do the math. 95 minus.
And they lost their cars and stuff. But
They have cars.
they had cars. They had all sorts of gas benefits and things. But there was actual an impact because some of the lawmakers, some of them were independently wealthy or whatever. They have businesses on the side, but some have families, and this is their only source of income, and losing it for a month is not an attractive thing. And then the question became, well, do you want that to be the factor upon which their vote is based? They're just going to vote for anything just to get their payback, perhaps. So it's a troublesome issue.
I will say this on follow-up. I don't think California will default. I don't think it's really conceivable that they would default, except in the context of maybe like vendor payments. That sort of, at that level, the state can be difficult to deal with. But if you're a bondholder, as to me, it's not really conceivable that California will default. That said, a lot of local governments in California are facing a lot of problems. They may have read the paper recently. Stockton, not a small city by any stretch of the imagination, is borderline going bankrupt. The city of Vallejo is going to actually file for bankruptcy. They're not alone. There are a lot of cities that have overbuilt in housing, and I think they could well face difficult problems, plus the local pensions, salary obligations. That you can see happen. But in terms of state bonds, and plus there's no way the federal government's going to allow the largest economy to profit.
Oh, the feds will step in.
Yeah, I actually attended a symposium on that question of what happens on that. And from that I learned that on that wonderful 2008 weekend when Fannie Mae and Freddie Mac entered conservatorship, you may remember we were very coy beforehand about whether they were actually guaranteed or not. And when it happened, the representatives of the Russian and Chinese bondholders who held all these Fannie and Freddie bonds came to the Bush administration official in the Treasury and said, okay, we're here. Is it guaranteed or not? And they apparently took about 5 or 10 seconds to say, yes, it's guaranteed. And I find it difficult to find a way that would not happen also for Illinois or California if creditors came calling, because It's a lot of money.
If you really thought that there was a risk, you would start seeing this as California goes every summer to the debt markets to pay for their budget gap problem. You'd start seeing those rates really go through the roof if there was really a sense in the market that they were at risk.
All right, this question
At
is,
the same time, Greece was borrowing at very low rates until a month before they could not access the capital markets anymore.
this question is directed to Mr. Henchman. How do we implement a stabilizing tax that doesn't fluctuate with the economy like the sales tax? And I'm struggling with handwriting, but I believe that's the question.
Different taxes are more volatile than other ones. Roughly, the property tax is probably the most stable of the major taxes. Individual income, except for Nevada, perhaps. The individual income tax, especially the portion on capital gains or high income earners, is very volatile, as is corporate income taxes. And then sales taxes is usually one of the more stable of those major taxes. So, different people have different perspectives. Some people talk about like a stool of different revenue sources. Ultimately, I mean, you just got to make sure that when the revenue is being volatile, that you're not extending that trend line into the future in a way that harms you.
Can I chime in on that real quick too?
Sure.
Just, and I'll make it quick. One of our long-term consultants who's been doing tax issues for 50 years always reminds people that tax volatility is not necessarily a bad thing from the sense of the taxpayer. When your income goes down, the amount of tax goes down. When your business is suffering, of course you're going to pay less. So it's from a government planning standpoint, yes, it's bad, but it also means that it's basing things on the ability to pay. And when the whole economy is tanking, if the taxes were still staying stable or going up, you'd have some major public sentiment to deal with.
All totally suspended.
Yeah, Sam, I'm going to jump in here too, if I could.
Good, because the next question's for you.
Okay, but I mean, stability is not the only feature you should look for in a tax. I mean, the most stable tax out there is the head tax. And ultimately, that may have worked well in medieval England, although it did give rise to the Sheriff of Notting Hill and Robin Hood and all that kind of stuff. But it was a very stable tax. No tax in a modern economy by itself is going to be stable if it is reflecting the economy as a tax should. I think what you should do is overlay on that some type of protection so that in years of prosperity, there are limits on how much of the revenue a governmental entity can spend, and the excess would be put into a rainy day fund that could be accessed automatically when the economy turns south. So I think trying to find the sole solution in a tax itself is probably not enough of an answer. You've got to overlay that with wise fiscal management.
Stable practices what he preaches is a very good reason.
All right, so Dale, we'll continue with you. You mentioned that the revenue did not meet estimate projections, but how costly is the tax to collect? And did it result in growth in the State Department of Taxation?
The tax did not meet its projections. I think in terms of cost of administration, no, it did not increase the budget of the Comptroller's office. And quite honestly, that was probably a mistake because it is a very complex tax, and the Comptroller, who is our tax collector, has been inundated with questions from taxpayers of, how do I calculate this? Do I include this in cost of goods sold? Am I allowed to include this in compensation? And we're not getting responses back as quickly as taxpayers needed. And now we're running into our first cycle of audits where taxpayers have said, I made the best guess I could as to how to handle this. And of course the auditor says, well, you guessed wrong. And the audits are always set up to the disadvantage of the taxpayers. And as a result of that now, we have construction companies that bid on contracts, understanding the tax to be calculated in a certain way. The Comptroller's office comes in after the fact and says, well, you guessed wrong. And the contracts have expired, the money's been paid, and now they have to figure out a way to come up with an audit settlement. So, I mean, I think anytime you have a significant change in tax, you should put more money into administration. Now, from a taxpayer standpoint, it is a more costly tax to administer than the old franchise tax was because it was a known commodity. And anytime you shift to the unknown, you're going to increase administrative costs on the taxpayers as well as they try and deal with where to dot the i's and cross the t's.
This one's for you also. Gas distribution company is not allowed to deduct cost of goods sold for Texas margin tax purposes. Any other typical costs that the gas distribution company could deduct? I think that's the question. And will the industry-specific guidelines be issued? In other words, are there regulations to clarify those provisions?
Well, I can't comment on where the controller is on issuing regulatory guidelines. With regards to a gas distribution company, if they are just distributing the gas, they are technically providing a service because they're not actually owning the gas and selling it. So because they are providing a service, they can't claim cost of goods sold. They are probably very capital intensive, don't have a lot of payroll. All their money is invested in pipelines. Consequently, they're very capital intensive. For them, they're probably claiming the 30% sort of automatic deduction, which is one reason why it was put into the act, because it was recognized there are some companies that aren't going to be able to deduct either cost of goods sold or compensation. So it was an effort to offer capital intensive services companies some type of deduction.
Okay, one more while we've got you. Not that you're going anywhere. The margins tax has to be paid whether or not a business is profitable. Does that make sense, particularly in an economic downturn?
It makes sense if you're collecting the tax. It may not make sense if you're paying the tax. And that is one of the criticisms of the margin tax, is it is not income sensitive. Most business taxes in other states are, but the margin tax is not. Now, that does give it some stability that a net income tax does not have, but it does have policy consequences.
All right, gentlemen, one for each of you, but they're both about rising energy prices and essentially inflation. I'm not going to try to read the writing. How can states protect themselves, state and local governments protect themselves from rising costs and inflation is essentially the heart of these questions. Or can they?
I don't know that they really, you're faced with rising costs, whether it be through mandates or whether it be through inflation itself. I mean, it's about trying to predict what your expenses are going to be. It is your typical budgetary problem and trying to anticipate down the road where your expenses are going to come from. I don't know how you can protect yourself necessarily from the effects of inflation. Michael.
How realistic is it to implement, and this is not for anyone in particular, so anyone who has an opinion, just feel free to jump in. How realistic is it to implement a successful new tax policy when we have a 120-day legislative session every 2 years? Many legislators are new with our term limits policy, and they have to be brought up to speed about many things, including budgeting and taxation. So would anyone like to address? You have the same kind of legislative structure.
We do. Texas is a biennial state. We meet every 2 years as Nevada does, although we meet 140 days rather than 120 days, which means we have 20 more days of receptions. But actual committee work really doesn't begin until the 60th day or even beyond. It takes a while to get organized. We do have professional legislative staff, a professional controller's office, so we do spend a lot of time in the interim working on policy issues with them. Texas does have a part-time legislature. Our salaries are $600 a month. We actually do have some lawmakers that when they opt into state insurance, they have to write a check to the state to cover the insurance because their paycheck doesn't cover enough of it. But The fact that we meet once every 2 years has not really hampered policy discussions because we have tended to rely on a lot of interim blue ribbon committees, and our legislature does have interim committee meetings in the off year.
Dave, backing up on this, California's got a full-time legislature year-round, pretty much always in session except for the fall, and they always would pass, well, the last decade in particular, a lot of the major tax changes that haven't happened by initiative that happened the last night of session. Stuff will just come out in the middle of the night. We've got elective single sales factor, whether you love it or hate it, as a consequence of exactly that. Nobody saw it. And so, I don't think a 101-day session really impacts you if you've got good staff doing the work and that you're willing to put the stuff out to have public comment on it. There's plenty of people that will comment on stuff if you give them the opportunity.
Right, all right. And another issue is if it's a major tax overhaul, you want to give it time. It doesn't have to be done right then in that session. I mean, some major tax changes in California have taken years and years. Getting rid of a business inventory tax, which was a great idea. It took 14 years to do it. So, I mean, part of that was just because of the politics, but, by the time they did it, they were well versed in how it would work. And so any major change, you can take your time, and it's a long-term situation.